Do you worry that the stock market is going to drop? So do most people. That's a very valid concern. But there are some tools that you can use to help you understand how likely the market is to drop. I'm going to share that with you in this video. Hi, I'm Camille Gaines. I'm founder of financialwoman.com, author of Earn, Grow, Give, and I've been personally investing for over 30 years, and I share about that here. Now, you might feel like at any time the stock market, the bottom's just about to fall out from under it. And no wonder, it happens every few years, right? That's called a bear market. So I'm going to share 3 different ways that you can get a feel for whether or not the market is due for a correction. Now, a couple of them are kind of complicated, so I'm going to share one at a time in this video series. And at the end of this video, make sure you stay tuned because I'm going to tell you how you can learn more for free. So the very first tool that I want to share with you to figure out whether or not the market is overvalued, which means probably headed to a bear market soon, is called the PE ratio. Now, right now, for example, as I record this video, and it varies on a daily basis really, so this will change over time, but right now as I record this video, the PE ratio for the S&P 500 index is about 26, okay? So the thing to understand about this is bear markets, which are those markets that are going down for an extended period of time, they almost always begin when the PE ratio is very high, and bear markets end when the PE ratios are low. So it's important to pay attention to that because you can get a good feel for what's in the future with the market, an idea of what's headed by knowing what the PE ratio is. It's one of the most important things for an investor if you're invested in the stock market. It's something that would be just so foundational for you to know if you're invested either in individual stocks or if you're invested in the market as a whole. Now, when I said the PE ratio is 26 right now, what I'm talking about is the overall stock market. So all the little companies or big companies in the index have a PE ratio, and then the stock market as a whole has a PE ratio that's usually associated with the S&P 500 index. I know if you've seen my other videos here or you read any of my articles at financialwoman.com, you know all about the index and how important it is for anyone that's invested in the stock or bond market. So what I'm referring to in this video is the PE ratio that's associated with the S&P 500 index because it represents the broad market, the big market in the US. You can refer to that as the market as a whole. So if the PE ratio is 26, what does that really mean? Well, it means that investors are willing to pay about $26 for every dollar of earnings in the companies in the S&P 500 index. So, taking out the index quotient, that means investors are willing to pay about $26 for every dollar of earnings, okay? So for comparison though, because 26 doesn't really mean anything if you don't know how much it usually is. For comparison, the PE ratio since the 1870s has been about 16.7%, so just under 17%, and that's according to Advisor Perspectives. Again, this varies over time. It doesn't jump hugely overnight, of course, but because the stock market is changing value every single day, this is a current number. You have to look at what the market is currently, the current PE ratio. Now, there are 2 really important things that I want to mention about the PE ratio. The first one is that trends usually last longer than you think. So the PE ratio can be unusually high and stay that way for another year, 2, even 3 years before the market drops, bringing that PE ratio down and back into alignment with that historical norm of 16.7%. That's the first thing. Trends always last longer than you think, and I could just go to town on that one, but I won't in this video. The second caveat that I want to point out is the PE ratio can be a bit wacky during major market swings, but it's still one of the most widely used tools by financial firms, investing firms, financial gurus in figuring out if the stock market or individual stocks are overpriced, whether they're cheap or whether they're really good value. So those are important things to know. Now, I do want to mention that you have to be careful when you look at the PE ratio, because sometimes, so let me give you the formula. It's the price, okay, so the price of, for example, a stock divided by the earnings that stock has. So price slash earnings, price over earnings. So we know we're looking at the index, so it's the price of the index divided by the earnings of the index, and that gives you the ratio. One thing to be careful of, and that is often, it makes it a little challenging to present, to compare PE ratios. Make sure that you're looking at current earnings or future earnings versus trailing earnings. So let me rephrase that. Make sure that you're looking at the same thing. So for example, the PE ratio, sort of the standard PE ratio, uses what a company has done the previous, they call it trailing 12 months. So the previous year. So it's based on how much money that company made, or the stock market as a whole, the index made over the past year. So that is the earnings figure that is used. So some PE ratios use the future earnings, the future projected earnings, and that gets really tricky because, well, we all can be really optimistic about what we think we're going to make, and then we may not make it. There are so many factors involved. So always make sure if you're using the PE ratio, you use the trailing 12 months, the previous year, in other words, that earnings figure. So in summary, I know this is a lot to take in, but it's a really, really important concept. And you don't really need to know that much other than this. Here's the deal, okay? The PE ratio is very important in determining if the market is overvalued or undervalued or fairly valued. It tells you how much you're paying for a certain amount of earnings, okay? So that's all you really need to know about that. The historical, very long-term PE ratio was about 16.7%. And then you just need to know what the PE ratio is whenever you're looking at this video or whenever you're doing your research about investing. Right now, as I record this, the PE ratio is just under 26. And so, as you can see, it's way over the historical norm of 16.7%. That tells us the stock market is expensive. It's overvalued now. Will it stay overvalued, and how much longer? We don't know for sure, but we do know from looking at this that right now the market is overvalued. It's not cheap. And that makes sense since the market has been going up for about 8 years now. The market is overvalued based on the PE ratio, and that's what I wanted to share with you in this video. The first tool is the PE ratio. If you want to learn more about this, be sure to grab my Investing Bricks ebook that explains the index more and tells you more about investing basics that you'll want to know. If you like this video, please click the little thumbs up below to let me know, and be sure to subscribe to my channel. Thanks.